Good evening. This is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our Q&A webinar. Before I start, I do want to mention a few items about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. We also don't represent or sell securities or investments of any kind. We are not a registered investment advisor, and we don't represent or endorse any investment opportunities that I might discuss during this presentation. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to cover some basic information about self-directed retirement accounts, investment options, guidelines in retirement account investing, the retirement account LLC structure that STC uses for each of our clients' accounts, the services that we offer, and then we will open the floor for your questions. So first, to get started, I do want to define what we mean when we use the term self-directed retirement plan. And what we mean is that you are working with a company, an entity that permits you to choose any allowable type of asset, anything that is allowed by law. And so that would include what some consider non-traditional assets like real estate. Self-direction also means that you're going to manage your retirement plan's investments. So, for example, if you had a real estate investment in your self-directed retirement plan, you would be the one to decide if you were going to rent that property and what that rental rate would be. You could choose the tenants. You would determine if you wanted to renovate something in the property, buy new appliances. So basically, you are going to be making the decisions that relate to the assets in your retirement account. So you have control. Now, there are a number of different types of retirement plans, and a self-directed plan is not a type of plan. Again, it's that you are working with a company that holds your plan and permits you to self-direct. So these are some retirement plans that you may be familiar with, a traditional IRA and a Roth IRA. Now, they're similar in that they have identical maximum annual contribution allowances. So from your earned income for the 2023 year, earnings in 2023, you can contribute a maximum of $6,500 into either of these accounts. And if you are 50 years or older, you're permitted a catch-up contribution of an additional $1,000 for a total of $7,500. The difference between these two plans is that Roth contributions, unlike traditional contributions and most retirement plan contributions, are made post-tax. And by that I mean you're actually going to pay taxes on the monies that you're contributing into a Roth account. However, after you've held that Roth for at least 60 months and you've reached what the IRS deems retirement age of 59 and a half, then you can take qualified distributions from your Roth account, and they will not be included in your taxable income in the year that you take those distributions. So you pay tax on your contributions, and if it's a qualified distribution, it will not be taxed, will not be included in your taxable income. So that means that monies that you have earned in a Roth account can, in effect, be tax-free earnings. A traditional IRA is pre-tax. You can make that contribution that will be deducted from your current year taxable income. But then when you do begin taking qualified distributions, they will be included in your taxable income in that year and taxed at your ordinary income tax rate. A SEP plan is a simplified employee pension plan. It permits a company, it can actually be a sole proprietor, can have a SEP, or a business owner. It allows for both employer and employee contributions, a larger dollar amount. It is based on the earnings of a business. And for 2023, the maximum contribution into a STEP plan is $66,000 from the earnings of the business that the plan is on. So something that you might want to consider if you are a business owner or sole proprietor. Simple plan, savings incentive match plan. Another type of plan I've heard used by sole proprietors, also by partnerships. It permits you a larger contribution than a traditional or a Roth. For 2023, $15,500 or a catch-up up to $19,000 from the earnings. So some other options if you are in business. And then now I've brought out onto your screen 4 plans that are labeled former employer. So a 401k is a for-profit company type plan. 403b, often used by nonprofits or charitable organizations. TSA is a tax-sheltered annuity, and a TSP is a thrift savings plan. Now, these all say former employer. So if you formerly worked for an entity and participated in one of these types of plans, then you can move the monies out of that plan and put them into a plan that you qualify for. Say, for example, a traditional IRA. Now, if you are still employed, then you will need to go to your employer's plan administrator and look at the specific plan documents and see if you are eligible to move any monies out of your current employer's plans into a self-directed. A solo 401k plan, that also has some other names. I've heard it is basically a 401k plan, but for a sole proprietor. It can be called a uni plan, a 401 plan. So it's basically a 401k plan, but for a sole proprietor, someone who is in business for themselves, by themselves. So really have very limited employees, only very part-time employees. You can have a spouse involved in the business. It permits a sole proprietor the opportunity to save in a retirement plan at higher levels. So it does permit both employer and employee contributions. It does have the opportunity in the plan documents to set up a Roth provision so that the employee's contributions into the plan can be designated as Roth contributions. So again, they would be post-tax, but and earnings would come out tax-free if they were qualified distributions. So you do have the possibility of a Roth provision in a solo 401k. And there's also a loan provision that's available. And that permits the business owner to take a loan from the funds in the retirement account. And they can be used for any business as long as they are paid back according to the plan terms and with the interest. So that is sometimes very helpful to a business owner to have that loan provision available. So if you are interested in more information about a solo 401k plan, please do get in touch with me. But that type of plan can also be self-directed. Now, in a self-directed retirement plan, you have a wide array of investment possibilities. And we often talk with folks who are very interested in different types of real estate investments in their retirement plans. So these are some real estate investments that I brought out onto your screen: single or multifamily homes, vacation investment property. And I do want to make a comment here. This does need to be investment property. So if you're interested in owning a vacation property, like a vacation rental at the beach in your retirement account, you must remember that you cannot use it personally because that will violate some of the rules related to retirement account investments. So it does truly need to be an investment property. Raw land, building lots, commercial buildings, real estate syndications, all of those are viable real estate investment possibilities. Tax liens. Now, this is a possibility to earn a very nice interest rate. Tax liens vary on the statutory interest that they earn. You will need to check with the governing authority where the property is owned that you're interested in purchasing tax liens, but they can pay very high interest rates, and they are foreclosable liens. So if they aren't repaid, you can actually foreclose on the property, and your retirement account could potentially actually own that property in your retirement account. So that would be a very inexpensive way to own a piece of property in your retirement account if you were able to actually foreclose on a tax lien. You can also invest in mortgages. You can make loans to others, say to other investors, other real estate investors from your retirement account. And when you're making loans, you would be setting the terms of those loans. Now, you do want to keep in mind that they need to be reasonable business terms for a loan. If you did something that was a very low interest rate to a friend, the IRS might wonder why you would loan somebody that kind of interest when you could earn a lot more. So you do need to be wise about choosing the terms of the loans, but you will be the one to set the loan's repayment date, the term of the loan, and the interest rate. Private business investments, you can certainly invest in businesses. You can also invest in operating businesses. One note here is you must keep in mind that if your retirement account is invested in a business, you cannot personally be involved in that business, nor can certain family members, because there are disqualified persons, and we're going to discuss those in a moment. So it does need to be a passive business investment for you. Precious metals. The IRS has defined certain metals and fineness standards that can be held in retirement accounts. So if you'd like to have a portion of your retirement investment in precious metals, that is permissible. The Forex market, foreign currency, options, futures, and of course, stocks, bonds, and mutual funds. So most financial advisors do recommend diversity in your retirement investments. So with a self-directed account, you really can invest in different types of assets, quite a range of different types of assets. Now let's talk a little bit more about guidelines for self-directing. There are rules that define what is permitted in all retirement account investing. Your retirement accounts are given tax preferential treatment. You're not taxed on the earnings of those retirement accounts. They're meant to benefit you when you reach retirement age. So there are rules that relate to what you can and cannot do in a retirement account and the investments there. There are some assets that are prohibited, one being life insurance contracts, with one exception. If your plan is a solo 401k plan, life insurance contracts are permitted as an investment, but otherwise they are not permitted. Another type of investment that is not permitted are collectibles, rugs, works of art, stamp collections, coin collections. So we're not talking about precious metals here. That's different, but we're talking about actual collections, collectibles. Those are prohibited assets. There are some transactions that are also not allowed. Remember that when you engage in transactions in your retirement account, they are meant to benefit the plan and to grow your retirement wealth, hopefully over time, and benefit you at retirement. So the transactions that you're engaging in do need to be for the exclusive benefit of the plan. You cannot personally borrow money from your retirement plan, and you also cannot pledge your retirement plan assets to secure a personal loan. Now, I have seen loan applications that do ask you to list your retirement accounts, but what they cannot do is they cannot be a pledge for that loan. They cannot be collateral for that loan. So you cannot pledge your plan assets to secure a personal loan. Nor can you utilize your personal credit or your personal guarantee to obtain a loan for the plan. So let me just explain what I mean here. Your retirement account can get a loan to purchase a property. That is permitted, but it must be what's called a non-recourse loan. It cannot be any kind of a personally guaranteed loan. And a non-recourse loan is more like a business loan, and it is a loan where the only recourse the lender has, if there is a default, is to the property itself. So that's why you can get a loan. Your retirement account can get a loan, but it cannot be personally guaranteed by you. And you also cannot benefit any disqualified person with a transaction that your retirement account engages in. So let's take a quick look at who disqualified persons are. And you'll see the first person I put up is you. You and your retirement account are two distinct entities. So let me give you an example. Let's say you personally own an apartment rental building in a college town. Your retirement account cannot invest in that because you own it, and that would be a violation of this disqualified person's rule. And if you're married and your spouse owns that, that would also be disqualified. It would be prohibited. So you and your spouse are disqualified persons to your retirement account. And there are other family members who also are disqualified. Ascendants, so that would be parents, grandparents, great-grandparents on up the line, and descendants, so that's children, grandchildren, great-grandchildren on down the line, are all disqualified. So if your father owned that apartment rental, your retirement account could not invest in it or purchase it from him. If your daughter owned it, your retirement account could not purchase it from her or invest in it. However, lateral family members are not disqualified. So lateral family members means brothers and sisters, aunts and uncles, nieces, nephews, cousins. Those are all lateral family relationships, and they are not disqualified. So if your aunt owned that property, if your nephew owned it, if your second cousin owned it, then that would be an opportunity that your retirement account could invest in. There are also some entities that your retirement account cannot do a direct transaction with. Any company, and it doesn't matter how the company is organized, S Corp, LLC, if you are a majority shareholder, then that entity, that company, is a disqualified person to your retirement account. Also, any company, if you're an officer, a director, or a highly compensated employee, also you're prohibited from investing with them because they're a disqualified person. So I often have real estate investors who are running their investing businesses through an S Corp or an LLC, some kind of a company, and they want to know if they can participate with their retirement account in those investments. And the answer is they can't do a direct transaction between if they're a majority shareholder or an officer or a director or a highly compensated employee, which they usually are. So just something to keep in mind. Now, I'm actually not giving you all these guidelines so that you become an expert, because that's what STC does. We will help you navigate these rules and regulations. I just want to give you an idea as you're thinking about investments, and if you are going to be partnering with others, getting you thinking along the right lines. But we will help you with all of the specifics of the rules. As a client, we'll help you understand what is permitted and what isn't permitted. Now, STC, for each of our clients' accounts, we set up an LLC structure that has a number of benefits. And let me talk a little bit about this structure. It is not a generic business LLC. So many people say, I already have an LLC, can I use that? Well, our LLC is designed, its articles of incorporation, its operating agreement have all been written by our attorneys so that it is designed to be owned by a retirement account. So it is a specialized LLC structure that we set up for each of our clients' accounts. Now, the reason that we do this is because there are some distinct benefits to running your self-directed retirement investments through this type of a structure. It gives you a great deal of flexibility, especially when you're structuring complex transactions. So let's say you are going to have a multi-party investment, so your retirement account is not the only owner. It's going to be a real estate investment. You and the other parties are going to get a non-recourse loan in order to finance part of the price of the property. And one of the parties is also going to be doing some renovation work. So that kind of a complex transaction is more easily structured in an LLC situation. It gives you a great deal of flexibility. And we can actually help you structure those kinds of complex transactions. Now, it is truly an LLC. It's a limited liability company, and it does provide an additional layer of asset protection for your assets. It also gives you checkbook control over your retirement funds. So that means that you can move quickly when an investment opportunity comes. You can get an immediate response and fund that transaction quickly. Good investments can come and go very quickly, so you want to be able to move on that. Now, you'll notice that I have checkbook control in quotes, and that is because at STC, we don't actually give our clients the checkbook. Some companies do. The possible danger in that kind of a situation is that you might unknowingly engage in a prohibited transaction. And engaging in prohibited transactions can have some fairly serious consequences, up to, penalties, taxes, to the full distribution of your retirement account funds and it being immediately taxable to you. So you want to be careful to not engage in any prohibited transactions. So what we do instead is our client services department will review your transaction, and then if it's all in line with the rules, then we can same day or next business day fund that transaction for you. So you really have our experts looking over your transaction. So it's, I like to call it protected checkbook control. You have, quick access to your funds, but you have experts looking over your transactions to make sure that you're staying within the rules. Using this structure also simplifies asset titling, and that is very handy in a real estate transaction. You do not have to send the closing documents for a real estate purchase to our office. Rather, you can go to closing on behalf of your retirement account. You are the investment co-manager of your retirement account LLC, so you can sign the documents on behalf of your retirement account. So it simplifies that whole closing process on a real estate transaction, simplifies asset titling. The assets are going to be titled in your LLC's name, not in account number 12345 FBO John Smith. But it's actually going to be your LLC structure name, your LLC name. So it does simplify the asset titling, and it also eases pooling or partnering with other funding sources, which you can do. Your retirement account does not have to be the full funding source of an investment. I've already mentioned that you can use a loan, a non-recourse loan, but you can actually partner with other funding sources, other people, other investors to co-own an investment that you own partially in your retirement account. So let's take a look at our retirement plan LLC structure. And here you'll see on the upper left, this is your current custodian, where your funds are held at the current time. So you've decided that you want to work with STC and open a self-directed account with us. So you will complete some paperwork that will direct your current custodian to transfer or roll over the funds whatever funds you want to. It doesn't have to be the whole amount, to our self-directed custodian. Then while that is happening, our operations department will be setting up the LLC for your retirement plan in the state of your choice. So you can tell us where you want that, and if you need some help in determining what states you would like to have your retirement account LLC set up in, we can give you some guidance on where you might want to do it and why you might want to do it there. Once that LLC set up in the state is complete and the funds have been received by our custodian, then the money is going to move, the retirement funds are going to move into a bank account that your retirement LLC has access to, and the membership interest, the ownership of that LLC is going to be held by the self-directed custodian. So now your money is in a bank. It's actually in a bank where our company is headquartered, which is Hagerstown, Maryland. So your money is in that bank, and now your LLC is ready to invest. Now, once you are all set up, your funds are there, then there's simple paperwork to complete to direct our client services department to invest. And you will send that paperwork to them, and they will review it, and if all is in line, then they will same day or next business day, if the bank cutoff has passed, fund that transaction. So here in this example, you can see investment number 1. Your retirement account has invested in a tax lien. So it wholly owns this tax lien investment. Your investment number 2 is a precious metals investment. Now, in the case of a precious metals investment, it's a very straightforward type of investment. You would find the broker that you wanted to work with. They would fill out, complete a form, what you want to purchase, direct it to us. The dollar amount would then be sent to the broker. The broker would send the precious metal to us, and that would be stored at our bank. So we have secure safekeeping for your precious metal. You cannot receive it because that would violate that disqualified person rule, but we will hold that for you in safekeeping. So precious metals investment, pretty straightforward. And then here you see investment number 3. This is interesting because your retirement account is one of 4 co-owners. And in this investment, these 4 co-owners pooled funds with others to purchase a small retail center. Now let's see who these others are. You see investor number 1 is your father. That's an ascendant. Investor number 2 is your daughter. That's a descendant. And investor number 3 is some personal money. That's you. Now you'll remember that I told you that ascendants, descendants, and you were all disqualified persons to your retirement account. So how did this transaction work? It does work. It is viable as long as this bottom yellow block is fulfilled. You are co-investors at the inception of the purchase transaction. So that means you all co-invest and purchase from the seller at the inception. And when you do this type of a transaction, the ownership interest must stay the same because otherwise it would violate the rules. So let's say your retirement account invested 25%, your father invested 50%, your daughter, so that's 50, 25, 75, your daughter 20%, and you put in 5% of personal money. So those pro rata percentages will have to be maintained to be the same throughout. So that would mean all expenses for this retail center would have to be paid by each investor according to their share of ownership. Monies earned by this retail center would be shared by these 4 investors based on their percentage of ownership. But this is a transaction that can be done, and we certainly have clients who do these partnering types of transactions. So something to think about if you're interested in, or perhaps you don't have sufficient funds to fully fund something. You don't have sufficient funds in your retirement account, but you might have access to other funding sources. So this is our LLC structure and how it might work with some investments. Now, I do want to, before I open the floor for Q&A, I do want to mention that STC is a full-service, self-directed retirement account administrator. So our full service includes a few things. So first, that LLC structure setup that I defined for you. Moving the monies from your current custodian to our custodian, the setup of the LLC, all of that is part of our service. That protected checkbook control I defined for you. We have CPAs and attorneys available to answer technical questions that you might have. We have a wonderful client services department that can give you really unlimited guidance on transaction compliance. So one thing I do recommend when you are looking at a transaction is talking with our client services department before you're ready to actually purchase, so they can review the documents, they can review who the parties to the transactions are, and just make sure that everything is in line with the rules. So that is what they are all about, is giving you that kind of service and guidance. We handle all the back office support. Now, there is administration that must be done with all retirement accounts, and we will maintain actual financial statements for your LLC. So you'll be able to see revenues coming in, expenses going out, any fees, if you make contributions into your account, if you begin taking distributions from your account. You'll be able to see all of this on financial statements. We will supervise the regulatory reporting that is required annually, and we will also oversee the annual valuation that must be done each year. So our goal and the services that we offer are to provide you all of the administrative support and all of the expertise on retirement investments that you need, so that you can focus your efforts and your time on finding the best investments for your retirement account. We have folks who have areas of investing that they have personally developed. Those same areas of expertise can often be used in your self-directed retirement account. So we'll keep track of all of the details, all of the administrative work, help you make sure that your transactions are in line with the rules and the regulations, and free you up to really find and manage the investments in your retirement account. So I do want to open the floor for questions, your questions. You can write those to me in the questions box on your slide. Somewhere on your screen you should see the word questions, and you can open that up and drop down and type that into me. And while I'm retrieving those, I am going to just give you a bit more information, and then we'll also look at some questions I received in advance. So how can we serve you? You may know that you want to open a self-directed retirement account, and we can help you and get you the paperwork and get you started on that. You may have clients in your business or colleagues who might be interested in learning more about self-direction. We're happy to get them information that they may need if they're interested, determine if they're interested, or you simply might need more information. If any of those are the case, then our website can give you some detailed information about our company. On that website, there's also information from clients, types of investments that they have done, and how STC has been able to help them, and a lot of defining information and some past webinars that you can also listen to too. Our corporate office number is there, and my direct email is there for any questions that might come up in the future. So I will leave that slide up so you can write that information down while I look back for some of these questions that I got earlier. So let me pull these out. Okay, I think I did cover this question, but I'm hoping you'll cover how to partner with yourself or family members to use some self-directed money and some from other sources. when you haven't got enough money. So I hope you understand that what you will do is you will communicate as a client with our client services department who the parties are going to be to the transaction, the dollar amounts that they are going to be contribute to the investment, and we'll confirm that they are not disqualified persons, or if they are, that this is all going to happen at the inception of the transaction, and then we'll give you guidance how to structure the transaction and the documents that are needed to make that happen. But yes, you certainly can, and as a client, our client services department can help walk you through how to do that. Okay. I would like details regarding management of property held within an IRA. Can I handle the checkbook? Do I need a management company? Okay, first off, this is a property you own in your IRA. So that means there are going to be revenues coming in and expenses paid out, etc. You actually cannot handle the checkbook because you are a disqualified person. So we highly recommend that you use a property manager. It's not required, but it's recommended because then everything flows through the property manager. If you don't use a property manager, then revenue checks, like from renters, would come to STC, and expenses would need to be paid out of your retirement account through STC. So a property manager expedites all of that process. So let's see, taxes related to loans on property. Okay, so this person knows that if you take a loan, have a non-recourse loan on a property in your retirement account, you can trigger something called UDFI, Unrelated Debt Financed Income, which is a subset of UBIT, which they put in their question. And that can come into play, and it is a calculation that if you have revenues and you have a loan, the IRS has determined that you are enabled to earn money through the use of that loan. So that's why they're going to tax that. Now, there are some specifics. Only the portion of the net income, it is based on net income, so you get to deduct all of the expenses from the revenues. Only the portion of the net income that's debt financed is subject to the tax. So let's say, for example, you got a loan for 70%, and your retirement account financed 30%. So your property is 70% debt financed. So only 70% of the net income will be subject to the UDFI. And then it is the first $1,000 is exempt, and then it's a graduated tax rate, and it is the trust tax rate. So that will come into play if you do use a loan and you earn income. And the taxes do need to be paid from the retirement account, but of course you've got income that you're paying the taxes on in the retirement account, so the money should be there. Let's see, is there any way to avoid those taxes? Nope, not really. And then, are there taxes on the sale of that property? If you have a debt finance property in your retirement account, there are taxes on the proceeds. And that again would be related to how much is debt financed at the time of sale. And I'll refer you to your accountant for the exact calculation of that. If you had fully paid off the loan 12 months prior to the sale, then there would be no UDFI at the point of sale. So that is something you will want to discuss with your tax accountant, because owning property can trigger UDFI in your retirement account. Okay. if I want to purchase a bank-owned house, they often require verification funds. How would I verify funds that are in my self-directed IRA? Okay, a bank-owned house. So that means the bank has foreclosed on a property and they have taken it back into their portfolio, so the bank owns it. Verification of funds, that's a simple request to our client services department. We can prepare a verification of funds letter. It will be as of a certain date, and you can tell us how much you want us to verify in that letter up to the maximum amount, the full amount that's in your account as of that date. So you would get in touch with our client services department and explain your situation, and then they can prepare that letter for you as an attachment to an email so that you can get that to whomever you wish. Do I have to have earned income in order to contribute to my IRA? Yes, you do. Contributions into retirement accounts are from earned income. And then a second question is, does money earned from rental income qualify? No, actually it does not. Rental income is considered passive income, not earned income. So let me just talk a little bit about what is earned income, because this is confusing for some people. So taxable earned income, this is from the IRS. You can look this up if you need more details. Taxable earned income, wages, salaries, tips, union strike benefits, long-term disability benefits, net earnings from self-employment. So if you operate a business or a farm. Here are some things that are not earned income: interest and dividends, retirement income, Social Security, unemployment benefits. So that kind of gives you an idea of the distinction between earned income and passive income. Can a self-directed IRA purchase futures, contracts, and options? If so, how do you open a brokerage account? Yes, you can. You would open a business brokerage account in the name of your IRA LLC, and you would go through our client services department, and then you can operate in that on the behalf of your retirement account. You can't put additional money directly into that account, and you can't take distributions directly out of that. It all has to flow through STC, as a contribution into the account. And if you're taking a distribution, then to STC and then out to you, because you're just managing it. You can't directly put money in and take money out. But yes, you can do that. Can I provide startup capital for a new business, such as a retail clothing operation or an auto repair shop? Yes, you should be able to. Couple things to keep in mind. You can't be involved with any disqualified person, so you'll have to be careful about ascendants, descendants, spouse. You personally cannot work there, or even not even that you can't take a salary, but you can't even contribute expertise or anything like that, because that is increasing the value. So you can't do that. It does have to be passive. What you may do is trigger UBIT, which is another form of tax. So something to think about. It can often be very, very lucrative to invest in those businesses, but you do want to be aware that on occasion, UBIT, unrelated business income tax, can come into play. So another thing to discuss with your accountant if you are interested in investing in a business. Can we invest in my son-in-law's LLC for his land acquisition, or as part of an investment pool for his home or apartment construction? We would say no, because your son-in-law is married to your daughter and your daughter is a descendant. So unfortunately, you do have to be careful about that. Now, you could co-invest at the inception of a transaction with your son-in-law, but this sounds like he already has an investment in place and you want to participate in that investment that's already in place. So that would be a no. Okay. Okay, this is a question I haven't gotten before. This is okay. This is someone who's required to take a minimum distribution. So you, in 2023, there are certain accounts that you must take a minimum distribution from if you have reached the age of 73. So this individual wants to know if she can convert her required minimum distribution to a Roth IRA. And the answer is no. RMDs are not eligible for conversion or rollover. You have to take them as a distribution and include them in taxable income. Okay, I've already answered that question. May an individual roll over IRA assets to an HSA? An HSA is a health savings account. The answer is no. IRS doesn't allow you to do that. Oh, and this is a question I have been asked before. Are individuals allowed to contribute to both a traditional IRA and a Roth IRA for the same year? Now, the answer is yes, you can, but you cannot do your contribution allowance, your maximum contribution is limited to that total dollar amount that I told you, $6,500, $7,500 if you're 50 or older. So if you had a traditional IRA and a Roth IRA, and you were 40 years old, so you're allowed $6,500. You could put $3,000 in the traditional account and $3,500 in the Roth. You can divide it up how you like, and you might be considering doing that based on tax consequence. But you cannot contribute $6,500 into a traditional and $6,500 into a Roth. It's an aggregate contribution. Okay, now you can convert traditional, this question, yeah, that's not a valid question, but anyway, you can convert traditional IRA funds into Roth funds. It does have a tax consequence, and if that's something that you want to do, because remember your traditional contributions were pre-tax, Roth contributions are post-tax. So if you want to convert traditional IRA into Roth IRA, you'll have to pay taxes on the amounts that's converted. But then from that conversion point, and you start earning, once that account is seasoned, it's 60 months old, and you qualify for qualified distributions, then the monies that have been earned in there are earned tax-free. They won't be included in your taxable income. Okay, so this is a partnership question. Can the retirement plan own 40% of a commercial business if 60% is owned by self and spouse? Purchased at the same time. Okay, because she added purchased at the same time, I'm going to make the assumption that she's talking we three parties, my retirement plan, myself, and my spouse, we all are co-investing at the inception of the purchase transaction in this commercial business. Yes, the answer would be yes. The percentages, they'd have to be very different, like 5%. Yes, it should be fine. 60 and 40 should be fine. Can the self-directed solo 401k be used to purchase stocks from a foreign stockbroker to purchase foreign stocks? I believe the answer is yes. It may be dependent on the actual stockbroker, but stocks, we have, I know we have clients who invested in real estate in foreign countries, so that would probably be a question we would have to ask the stockbroker if they can accept retirement account investors. If I can, okay, I answered that question. All right. Let me see if I have any additional questions before I close out here. Can you tell me more about investing in precious metals? What if you own a jewelry store? Okay, jewelry would not be considered precious. I mean, it is precious metal, perhaps, but not precious metal as defined by the IRS. And as suitable investments in a retirement account. So investing in precious metals, the IRS, I actually have a document that I can send you if you're interested, but there is gold, silver, and platinum precious metals that STC can accept on behalf of our clients, and they can be coins, can actually be bars, gold bars, certain silver bars, certain coins, platinum. So this is not jewelry. We're not talking about jewelry. We're talking about actual metals that are in coin or bar form. And if you would like more information about that, you can get in touch with me. Can we transfer funds from another company to your company without penalty? You can certainly transfer retirement monies from one custodian to our custodian. Now, whether or not your current custodian or administrator is going to charge you for that, that would be something you need to ask them. Penalty, there wouldn't be any IRS penalty in moving funds between custodians. Now there is, let me just add on to that, there is the opportunity for a retirement account owner to do what's called a 60-day rollover once a year and one time in a calendar year. And that is when the custodian actually sends a check to the retirement account owner for funds. And those funds must be reinvested in a retirement custodial account within 60 days, or those monies will be considered a distribution to the retirement account owner and will become taxable income. So now that's a 60-day rollover. That's a little different than moving money from custodian to custodian. So if you did do a rollover, if you did take that money, you got the check from your custodian payable to you, and you didn't put that money back into a retirement account within the 60-day period, then the penalty is it becomes taxable income to you in that year. So something you definitely want to be aware of. Once an account is set up, is it difficult to add more funds into the account? Is there a time factor? Okay, once you have an account set up with STC, you can make contributions as you are eligible to. So if it's traditional IRA, you can contribute $6,500 or $7,500 from your earned income. And you send that money to us. As a client, you'll get a binder that tells you how to do that with appropriate forms. If you are moving money from another account, because you could set up an account with STC and move part of your retirement funds to us, and then perhaps you want to transfer more in a future year. So that's just simply another transfer. So no, that's not difficult. and there's no time factor to do that. And now, if we're talking about a contribution, that is a calendar year contribution. It does need to be made before you file your tax returns for the future year. So that there's that time frame. Okay, I'm looking at my time. I have time for just a couple more questions. Are beneficiaries permitted in the LLC? Now, our setup, the LLC is owned by the retirement account, and the retirement account does have beneficiaries. The trust company holding that account, you will list beneficiaries on that. Does the LLC have to be set up in my home state? Can it be in the state of STC? I will say that it does not have to be in your home state. And when you are considering where to set it up, our operating department can give you some guidance if you're thinking of a particular state, or if you're thinking of doing real estate transactions. Perhaps you do want to have your LLC set up in the state that you're planning to do the transactions in. So it doesn't have to be the state that you live in, though, no. Some states do charge a higher LLC fee, and there are some states that don't. So that might be a consideration for you, too. Okay, I'm going to do one last question. What is the time frame to get my account up and running with STC? Typically, we ask for, and it may take 4 to 6 weeks from the time that we receive the original paperwork. Now, the reason for that is that time frame includes getting the money moved from your current custodian to our custodian. So that is a process that we can initiate, but we can't necessarily expedite because they will have their own time frame. And you will be the one to work with them to try to expedite that process if necessary. Now then, we also are setting up the LLC in the state you choose. So we can initiate those documents, but we cannot necessarily speed up the state's preparing the LLC. So we will stay on top of that. It can take much less time, but we do ask for that amount of time in case there are any time lags from the custodian or the state. Now, what we will do is we will keep you updated, when we get the money from your custodian, when we get the LLC set up, and then as soon as the money has moved into the bank account for your LLC, then we will let you know and you're ready to start. Now, once that has happened, then you have that immediate turnaround on investments. So you can same or next day fund a viable transaction. But there is an initial setup period. So if you are already thinking you want the self-directed account and you are already thinking about investments you might want to engage in, please do check with us for the paperwork and we can get that started for you. Thank you so much for joining me this evening. I hope you will let us know if we can be of service with you. Call our office. Send me an email. We would love to help you. And I hope you'll join us for our next webinar next month. Thank you. Good night.